All right, hope everyone's doing well. Today I'll be talking about discounted cash flow valuation. So I'll be reviewing enterprise value versus equity value, the time value of money, and overall what gives a stock value. So first, enterprise value versus equity value. To find the value of a stock, first we want to find the value of a business's core operations by projecting out the business's future cash flows and discounting them back to present value. This gives us the value of business's core operations. It's just the present value of a business's future cash flows. And then we can subtract debt from this amount and add cash to find the value of business's equity. As an equity holder, we derive all value from dividends or share buybacks, a business returning cash to us. So presumably the value of equity is just our current cash plus the present value of future cash flows, and then minus the debt, because debt equity holders are the residual claimant. Equity holders only get paid after debt holders have been paid out in full, right? Equity holders are incurring more risk, but they also have the advantage of having all of this upside in the future if a business does well and their future cash flows are really high. So I'll review the time value of money with this little scenario. If an investment in this certain asset was guaranteed to give me $100 3 years from now, let's say this is risk-free, what is the value of this asset to me? How much would a rational person invest in this asset in anticipation of that return? Would I be willing to invest $100 into this asset? I'd invest $100, and in 3 years from now, I would get $100. Well, no, I would not, because I would want to be compensated for having my money tied up, right? I could invest in something else. There's this opportunity cost. Only a foolish person would be willing to invest $100 and then just get the $100 back 3 years from now. You would want to get some sort of return for that investment. So this is this whole principle of discounting. If other risk-free assets, like a US government bond, were yielding 4% returns, then I could find the value of this investment with the following calculation. 100, which is the cash flow, divided by 1.04 to the third power. This gives us this $89. So the most irrational person would be willing to pay for this asset would be $89, because that would yield an annualized return of 4%. And that is comparable with other returns of the same risk, right? Now, I would say, yeah, $89 is a fair price because I'm getting a 4% return for an asset that's virtually risk-free. So they're essentially paying you for this opportunity cost, right? You're not incurring any risk. So you're basically just getting paid to have, your money tied up in this asset. So I probably wouldn't want to pay $95 because then I'm only getting a 1 to 2% annual return, where I could be getting a 4% return elsewhere if I invested in US government bonds. So I definitely want to be getting at least a 4% annualized return. But not all assets are risk-free. So what if this asset did have some risk attached to it? Would I still be willing to pay $89? Well, no, I would not, because now it's not a guarantee that I will get my money back. So the amount of money I'd be willing to invest would depend on the riskiness of this asset. If it was really risky, like a Coca-Cola bond, for instance, then if it's not very risky, like a Coca-Cola bond, this is nearly risk-free, I might only demand 5% return. It's just a bit higher than a risk-free asset. Whereas if it's a substantially more risky asset, like an AMC bond, I might want a 20% return. Remember, AMC is the movie theater company that might go bankrupt. So this would make the Coca-Cola bond worth $86 and an AMC bond worth $58. If the asset is similar to a Coca-Cola bond, it'd be worth 86. If it's similar to an AMC bond, it would be worth only 58. So it's this whole principle of discounting cash flows back to present value based off of how much the cash flow is, how risky it is, and when you'll be getting that cash flow. That's just the core of valuation in general. So now let's talk about this in the context of businesses. What gives a stakeholder of a business value? Why are stocks worth anything? Are they simply trading cards for businesses, right? If I buy an Amazon stock, what does that really mean? And why is it actually correlated to the underlying business of Amazon? Well, an investor derives value from a company using their excess cash to pay money to their stakeholders at some point in the future. So for bondholders, this is through coupon payments. And for stockholders, this is through dividends. For a bondholder, they would want their company to do well, because if you invest in Apple bonds, you want them to have enough cash to pay you back in the form of these interest payments, which we call coupons. And for a stockholder, if you invest in Apple, you also want them to do well because that means they might be able to pay you higher dividends in the future, right? But what about companies that don't pay dividends? Companies like Amazon or Berkshire Hathaway have never paid dividends in the entire history of their companies. So why do these stocks have any value? Are they simply just trading cards, right? If Berkshire Hathaway has not paid a dividend ever, but it's gone up so many thousands of percentages during the 50-year company history, why is that? That just doesn't make any sense to me. Well, it's because of the expectation that in the future they will return cash to their shareholders. Companies like Amazon or Berkshire Hathaway are confident that they could earn a return on reinvesting their profits back in the business that is greater than their shareholders could earn if they had the cash themselves. But there's this expectation that eventually at some point they will pay a dividend. If they came out tomorrow and said, we're never going to pay a dividend ever, then this stock would be worth $0. Maybe someone would still be willing to pay for it just because it's like a trading card, but it at its core is worth $0 because there's no cash flows associated with it. These companies like Amazon or Berkshire Hathaway have the philosophy, we can invest this money and get a higher return on this capital than you could investing in some other asset if we gave you the cash back. So they're not, giving dividends yet, but sometime in the future when they have no good reinvestment opportunities, they presumably will, right? And that's why people are willing to pay so much for Berkshire Hathaway because they've reinvested this money so well throughout the years rather than giving it back to their investors in the form of dividends. But eventually, at some point, these companies will pay out dividends, and that's why these companies do have value. On the contrary, cigarette companies who don't have many good reinvestment opportunities due to all the regulation and decrease in U.S. smokers, they are using most of their profits to pay back their shareholders through dividends. They're not reinvesting much back in their business. They're basically just giving all of their profits back to shareholders because they realize there are just not many good reinvestment opportunities in their industries. So it's super important to realize how we value companies in the grand scheme of things. Just like that $100 example, we are doing the same thing for companies. When we are thinking of a company, we're trying to calculate all of their future cash flows similar to that $100 we had, and then discount them back to present value, depending on how risky these future cash flows are, right? If it's a stable company like Coca-Cola, we can bet on people continuing to buy Cokes and Diet Cokes across the world. But if it's a really risky company, like for instance, FTX or whatever, the company that just went bankrupt, maybe we would want to discount those cash flows at the very high discount rate because of the risk associated with investing in that company. So it's all very important to consider, and that is the crux of discounted cash flow valuation. A DCF is a financial model that is an intrinsic valuation that is projecting out the future cash flows of a business into perpetuity forever, and then discounts them back to present value. And through this, we can determine the enterprise value of business. And it is super important to consider the value of business before investing in it. Throughout financial history, during periods where all assets are basically going up, people have kind of abandoned valuation. They've kind of operated under the assumption, I'm just going to buy this asset and someone will be willing to pay more for it. You've seen this with Bitcoin, with the dot-com bubble, with the stock market crash of 1929. During these bubbles, people have invested so much and all this hype has gone up that markets only go up, and then they have suddenly crashed when this quote unquote music kind of stops, and you can be left holding a worthless asset, and this is very bad, right? So it's always important to consider valuation. You can't operate under this greater fool theory that there will always be a greater fool out there that is willing to invest for more than what you paid for it. You need to always consider this intrinsic value, the present value, the future cash flows before you invest, because this makes investments much less risky. If you're confident you're investing in something that is undervalued, trading at a price that is below the intrinsic value, then it's very hard for you to lose money on this investment unless you just didn't predict something. But it's just very important to consider this. So 3 main questions I'll be answering today is, how do I define cash flow? What is the discount rate that I use? And how can I project out cash flows forever, right? How could I presumably predict a cash flow 200 years from now? I'll be answering all of these questions today. So first, how do I define cash flow? For a DCF, we use unlevered free cash flow. And unlevered means removing the effects of debt. Free means cash that we can use to pay investors, whether it's debt or equity holders, that won't disrupt the business's operations. So enterprise value should be unaffected by capital structure because it is just the value of businesses operating assets, right? It is, the amount of debt or equity a company has, on the right side of the balance sheet should not affect the value of the operating assets. So this is why we are unlevering this cash flow to remove the effects of debt. So I'll show you how we calculate this unlevered free cash flow. So we do EBIT, our operating income, times 1 minus tax rate. And we get to NOPAT, which you've never heard before. It's net operating profit after taxes. And this is kind of what we are using instead of net income. As you can see here, we're kind of skipping our interest expense. We are not subtracting it out because interest expense is related to a business's capital structure, and we want to make this basically independent of capital structure. One business might have a ton of debt, where one company might have no debt, and the company with a ton of debt will have a much higher interest expense, but this should not affect the value of the business's operating assets, right? So we're just going to remove this interest expense now, and I'll show you how we basically account for it later. So we'll get to this NOPAT, and then we will add depreciation and amortization because it is non-cash, and then we'll subtract incremental investments into our working capital and fixed capital assets. Fixed capital assets, that'd be a capital expenditure, right? You're investing in long-term tangible or intangible assets, and then you subtract your change in net working capital. For instance, maybe your net working capital goes up because you buy inventory that you haven't sold yet, or maybe you have a lot of accounts receivable, cash you have not gotten yet, or maybe your net working capital goes down because your deferred revenue has gone down a lot. Your deferred revenue went up a lot. You got paid a lot of cash. You need to factor this in because these can be cash inflows and outflows related to your operating activities. So this is another thing to consider. So you just get your NOPAT plus D&A minus capital expenditures minus change in net working capital. And I have that whole video on it 2 videos ago, and you can go check that out if you want to see more about all the accounting behind all of this. So for an example, Carter has revenue of $100 every year, an operating margin of 40%. And Carter has $200 of debt with a 10% interest rate and pays a 20% tax rate each year. Carter invests $10 every year in capital expenditures and $5 into working capital and has yearly depreciation of $10. Calculate net income and unlevered free cash flow. So for net income, we just get to our EBIT minus interest, and our EBIT is $40 because our operating margin is 40%. 40% of 100 is 40 minus 20 because we have 10% interest on $200 of debt. So we have $20 of interest. So our earnings before taxes is $20. And then we just multiply it by 1 minus the tax rate, and our net income is 16. With unlevered free cash flow, we are removing the effects of debt and also considering working capital and fixed capital investments and adding back D&A. So we get our 40, which is our EBIT, multiplied by 1 minus the tax rate, it's a 32. We add back depreciation, $10, subtract CAPEX, $10, and subtract our change in net working capital, right? So our free cash flow would actually be $27 because we are not actually subtracting interest. That's why it's so much higher, even though we are including these investments in the fixed and working capital and also, adding back depreciation. But you can kind of see the difference in these calculations. The main thing is that we are unlevering our, cash flow. We're removing the effects of interest and then also including, adding back depreciation and these investments into fixed and working capital, as you can see here. So now let's talk about discount rates. So the 3 steps here are, calculating out the future cash flows, right? And then discounting them all back to present value. And the 3rd step I'll show in a second. But the discount rate is a big part of this, right? How should I determine the discount rate to discount an entire business's unlevered free cash flow back to present value? Similarly to the first example, which I had that $100 investment, you must analyze the risk that the stakeholders of the business are incurring to determine the value, right? If it's a really risky asset, it will have a high discount rate. If it's a not really risky asset, it will have a low discount, right? So if stakeholders across the business are incurring risk comparable to investment that yielded a 10% return, the discount rate we would use is just 10%, right? We discount all the free cash flows by 10%. However, it is much more complicated than this because different stakeholders in a business are incurring a different amount of risk depending on where they are in a business's capital structure. I'll review this a little bit. With capital structure, right? There's a lot of different stakeholders in a business. You might be might have been a bank that loaned a business that is secured by their inventory. This would be very low risk. You probably expect a low return because you're not incurring much risk. Or you could have mezzanine debt, which is, high yield debt. It's a bit more risky, but still not as risky as like common equity, which is just like a stock, right? They are incurring the most risk because they are the residual claimant. If a business, goes down a lot in value, they might get wiped out, or if a company went bankrupt, for instance. So all of these stakeholders are expecting different amounts of returns. But if we're just trying to find the entire value of a business, we're going to have to kind of average out these expected rates of returns, right? Maybe half of a business is debt and half of it is equity. We would need to find the expected return for each stakeholder, which is presumably would be different. And then we would need to kind of average these together to kind of find the weighted average expected rate of return. And what we actually call this is weighted average cost of capital, or WACC for short. And this is a very important concept. Because of all of these different stakeholders, we must find a weighted average of the expected returns of all the different investors across a business's capital structure. It is the cost of raising capital for a business as it is what they will have to pay out to investors, right? Therefore, it is called weighted average cost of capital. A company's WACC will depend on the riskiness of a business and how its capital structure is structured, right? If a business is really risky, it will have a high WACC. If it's less risky, it will have a lower, weighted average cost of capital. So this is the formula for WACC. We weight debt and equity accordingly, depending on how much they, make up of a business's capital structure. So you can see this formula. It's the weightage of equity times the cost of equity, the weightage of debt times the cost of debt, times 1 minus the tax rate. So weightage of equity, if it's 50% debt, 50% equity, would just be 50%, or 0.5. And debt holders get paid through interest payments, which reduces a firm's taxes as it is an additional expense on their income statement. So we must multiply the cost of debt times 1 minus the tax rate to find the true cost for the business itself, right? It's the cost of capital. So we must multiply it by 1 minus the tax rate. I'll show you like a little example here. For instance, if a business has $20 in earnings before taxes, it would normally pay $8 in taxes, assuming a 40% tax rate, and the net income would be $12. But if the company paid 10% interest on a $100 loan, then now its earnings before taxes would be $10. So now the company will only have to pay $4 in taxes, meaning net income would be $6. So even though this company now had to pay $10 in interest expense, its net income only went down by $6 because of this tax shield. They paid $4 less in taxes. So their interest went up $10, but they paid $4 less in taxes. So this true cost for the business was only 6%, even though the interest expense was actually 10%, because they got to pay less taxes. So this is why there's this tax shield in the formula. If the cost of debt is 10%, then it's really only effectively 6% if the company has a 40% tax rate, right? It's just this tax shield. Having interest will lower your taxes, and it won't increase net income by exactly what the interest amount is, right? There's this tax shield. So there's a few different ways to calculate cost of debt, but just remember with discount rates, it's all about risk and reward. If it's riskier debt, debt holders will demand higher returns. This is just core to these concepts. So cost of debt is just the expected rate of return for the average investor of a company's debt. It is essentially a way to measure the riskiness of a company's debt, and presumably a riskier company would have a higher cost of debt. And there are three main ways to calculate the cost of debt. The first way, the most simple way, is just the total interest expense divided by the average book value of debt, right? If an average book value of debt is just the debt over, the last 2 years. So if a company in 2021 had interest expense of 1 million, we would look at the end of 2020 and the end of 2021, average those two amounts, and it would be this 1 million interest divided by the average of those two amounts. If the average was 10 million, then it would just be a 10% cost of debt, right? 1 million interest divided by 10 million average book value of debt. The second way, which is the best way, is to average the yield to maturities of a company's debt. And yield to maturity, as I mentioned in my intro to bonds video, is just the IRR of a company's debt. And it factors in the market value of debt, which is good, right? Because if the market value of debt is down a lot, this would mean that our yield on the debt would be higher, which the first way wouldn't necessarily take into account, right? It's just basically doing the coupons divided by the book value of debt. If the company became a lot more risky after the company issued that debt, then the market value of the debt would go down because this debt would be discounted back to present value at a higher rate, right? So if you really want to, factor in risk as well as possible, you'd probably want to do the second way. The third way, which is also pretty good, is using credit spreads. As I mentioned in the bonds video as well, all these rating agencies come out with, different ratings for bonds. A bond might be AAA, which would mean it's very low risk, or it might be triple B, which would mean it's like semi-risky. And there's all these spreads out there in relation to the risk-free rate, these U.S. Treasury bills. They might say triple B rated bonds should give 5% higher yields than a U.S. Treasury bill based off of all these factors. So you could just look at what a company's debt is rated by these rating agencies, and then just tack on the spread to whatever the risk-free rate is. If the risk-free rate is 4% and the bond is rated triple B and the spread is 5%, you would just do 4% plus 5%, and you would get to 9%. And these are all a bit more complicated than this, but this is just like a short explanation of each. I personally, and I think most people would prefer yield to maturity because I think it's best factoring in the current risk of debt. And it's the best way to really figure out the expected rate of return for the average investor of a company's debt. So now cost of equity. This is just the expected rate of return for equity investors of a company. And this is harder than calculating the cost of debt, sadly, because the cash flows are not predetermined with debt. You can, it's pretty accurate, it's pretty easy to project out the cash flows. They're given to you. You are promised to receive interest payments if you're a debt holder. But with equity holder, it's much more unpredictable. You don't know when the company is going to do dividends in the future. It's much less predictable, right? So the most common way to calculate the cost of equity is through the capital asset pricing model, which we call CAPM. And there's a lot of debates on whether this is the right way to do it, but this is definitely the most common way to do it, even though it's kind of theoretical. So the formula for CAPM is just cost of equity, this expected rate of return for equity holders, equals the risk-free rate, which is our kind of benchmark, plus beta times market return minus risk-free rate. So this market return minus risk-free rate is the equity risk premium. It's the market return minus risk-free rate. And it's kind of the expected rate of return of the entire stock market subtracted by the risk-free rate. So it's the amount of return equity holders expect to be compensated for incurring additional risk. It's basically like, if I'm an equity holder and I just invest in the S&P 500, which we kind of use as a proxy for market return, how much would I want to be paid out for incurring this risk in comparison to a risk-free asset? Maybe it's 5%, maybe it's 10%. There's a lot of different ways to calculate this equity risk premium. And once I've said, there's a lot of debate among academic scholars, but it's basically just the premium, the return you would expect over the risk-free rate. And the beta shows a particular stock's volatility in comparison to the entire market, the S&P 500, and allows us to measure the risk of a particular stock in comparison to the market. So maybe if a stock has a beta of 2, if the market went up 5%, that stock would go up 10%. It's more volatile than the market. It's double as volatile. It's more risky. So I'll give you a little example of how you can use this, pricing model, and hopefully it'll make more sense. So cost of equity equals risk-free rate plus beta times the market return minus the risk-free rate, which we call the equity risk premium. So right now the risk-free rate is 4%. The historical return has been around 10% for like the stock market. So therefore, the cost of equity for a stock that is comparable in risk to the overall stock market is 10%, right? A beta of 1 would be 10% because we would have risk-free rate of 4% plus beta of 1 times 10 minus 4. So it's 4% plus 6%, basically. However, if a company had a beta of 2, then the cost of equity would be 4% plus 2 times 6%, and this would equal 16%. So it's basically just showing our risk-free rate and then tacking on this expected return for investing in the market. It's basically risk-free rate plus beta times this equity risk premium. And if a beta is high, then this premium will be even higher, right? Because you're investing in a riskier equity than the entire market, right? Like right here, the cost of equity would be 16% because you're investing in such a risky stock. So those stakeholders would want to be compensated for incurring this risk. This is very theoretical, but it's just kind of just the main way that we calculate cost of equity. It's kind of just how much additional risk in comparison to risk-free rate. This is the formula that we use to do it. I'll dive deeper into this in future videos. So this is the formula for weighted average cost of capital. After you find the cost of debt and cost of equity, you can find the WACC for a company. And cost of equity will always be higher than cost of debt. This makes sense. Equity holders are the residual claimant. They incur more risk, so they should definitely expect more than equity holders. And this is the discount rate we use to calculate all of our future cash flows, right? This formula right here. We have our cost of equity plus the cost of debt, and then this weightages, right? If it's 50% debt, 50% equity, then it would be 0.5 times cost of equity plus 0.5 times cost of debt times just 1 minus the tax rate, because these interest expenses are tax deductible. They are reducing the taxes on our income statements. So the third question I answered is, how can I possibly project out cash flows forever, right? Unfortunately, we cannot feasibly project out a company's future cash flows forever. So instead, we typically project out the cash flows for a certain projection period, usually like 5 to 10 years, and then calculate a terminal value for the company. Terminal value is just the value of the company after the projection period. So for instance, if we project out the company's cash flows for 10 years, our terminal value would be the present value of the company's cash flows from year 11 to infinity. So you can kind of just think of it like we are trying to calculate the cash flows for each year forever. So from year 1 to year 2, year 3, year 4, forever. So we'll just calculate the first 10 years doing in-depth analysis, and then we'll kind of calculate a terminal value to comprise all of the rest of these cash flows. So we are calculating all the cash flows in the perpetuity, but we are kind of using a shortcut to get to the very best because we couldn't feasibly project them all out, right? That just wouldn't make sense. You can't really have an accurate projection 30 years down the road. So there's two main ways to calculate terminal value. Two ways to calculate it are the multiples method and the Gordon growth method. The multiples method just involves multiplying a final year of the projection period metric by a multiple, right? I talked about this. This is kind of using relative valuation. You're kind of mixing the principles of intrinsic valuation, because you're doing a DCF, with this relative valuation. So if our projected year 10 EBITDA was 1 million, so we've projected out cash flows for 10 years, and our EBITDA in year 10 is 1 million, and multiples for similar companies in this industry are 10x EBITDA, then our terminal value would be $10 million. So our EV to EBITDA is 10x times 1 million EBITDA, and our terminal value would be $10 million. And this is the present value of the cash flows from year 11 into infinity, right? People are willing to pay 10x the EBITDA in year 10 to receive all of these cash flows from year 11 onward, right? This is this terminal value. It's the present value of the cash flows from year 11 to infinity. But keep in mind, it's the present value in year 10, right? Not the present value in year 0 or right now. And I'll get into that later. The second way is to use the Gordon growth model. The Gordon growth method uses the formula free cash flow times 1 plus the growth rate divided by R minus the growth rate, with G being growth rate and R being the discount rate. And this is very similar to the perpetuity formula I showed you last time, which was just free cash flow divided by 1 minus R. It's just free cash flow divided by discount rate gets you to the value of a perpetuity. Except now it's factoring in growth. So a company with a free cash flow of 1 million and a growth rate of 2%, a discount rate of 10%, if you plug that in, this would give you a terminal value of $12.75 million. And this is typically kind of how you do it. A growth rate should not be too high, because this is after we've projected out the cash flows for a very long time. So presumably the company won't be growing at a much higher rate anymore. It'd probably be like 2%, something similar to like the US GDP. And then the discount rate can just be somewhat comparable to similar risky assets, right? So in this case, 10%, I guess that would be an appropriate discount rate. It all depends on the riskiness of the assets. There's some criticisms of both the Gordon growth method and the multiples method. The multiples method is not really truly intrinsic, right? It's a relative valuation. The Gordon growth method really is intrinsic, right? Because we are using, growth and our discount rate. And this is intrinsic, right? We're just focusing on this company alone and not other companies and using this relative valuation. But criticism is that a company won't have a constant growth rate forever. And it's a silly assumption to make. Neither of these are perfect, but it's kind of the best we can do. We cannot feasibly project out the cash flows forever. So these are two ways to calculate terminal value. And once you get the present value in the final year of the projection period, you will then discount it back to now. So you have the present value in year 10, but now you need to bring it from year 10 to year 0, or right now. So for instance, if our terminal value is 10 million 10 years from now, we did it like a few minutes ago, 1 million EBITDA times 10x, like I did 2 slides ago, then we would get to 10 million. And then the present value with a 10% WACC would be 3.9 million, right? We're doing 10 million divided by 1.1 to the 10th power. So this is how you get the present value of the terminal value. So what you're really doing is just getting all the future cash flows and arriving at a terminal value. And then you discount them all back to present value to arrive at our implied enterprise value. And then you back into equity value, enterprise value, or equity value equals enterprise value minus debt plus cash, right? And then you're discounting all these back to present value using the WACC, of course. So this was a lot. This was, this is kind of a crash course. I'll go more in depth in a future video. But just remember, although a lot of these concepts are theoretical, at its core, valuation is about cash flows, risk, and when the cash flows will be, right? I think there's like the old saying, one bird in the hand is more than like two in the bush or whatever, right? This is very similar to investing, right? You're investing the cash in your hand for potential cash in the future, the cash that's in the bush. So it's all about how much cash is in the bush, when you're going to receive the cash, and how risky that cash actually is. These are the most important things when you're considering valuing a company. Valuation is super important for all of the reasons that I've mentioned. And I hope you enjoyed this video. I'll keep diving into this in future videos. But yep, have a nice day.